All right, here we are. We're talking real estate. You know, last week reports show that the average 30-year fixed mortgage rate is now at 4.67%, which is an increase just from where it was a week ago. Just below 4.5% was where it was. So many first home buyers are feeling a little backed into a corner and simply walking away from buying a home. But should they? Because I don't think 4.67%, that's not astronomically high, Aprile. I mean, come on now. So Aprile Osborne from Closed International Realty is joining us this morning to talk more about these interest rates. So, okay, let's before we jump into where they are now, let's go back to where we were a little over a year ago when you were seeing them in the twos and stuff like that. That's when a lot of people refinanced or bought. Yes. So I can kind of see now where 4%, 4.6% might look high. But is it still high? Should people be fearful about that?
It is so cheap. It's such cheap living. I mean, like, you know, back in the day, people were getting mortgages at 17%.
Yeah.
I mean, come on, it's not that deep. And if you look at it, if you break it up by 1%, every 1% increases by $100,000, that's $50 a month.
Right.
So, you know, first-time home buyers are absolutely getting affected. And what they're saying to me and other realtors I've interviewed and talked to, the thing that they're saying is, I just might not go out to eat that extra time a month. Or I'll cut here, I cut there. They're not cutting in their homes. You know what I mean? They're cutting other places. $50 per 100,000 per point.
Yeah.
So say it's $100 a month per se, right? They're just not spending $100 a month somewhere else.
Do you think those interest rates might go higher than where they are now? 4.6?
I think they're going to go a little bit higher, yeah, but I'm not, again, afraid of it.
Yeah.
It's, you know, the feds are doing this to counteract, you know, inflation, which is we are at a 40-year high of inflation. And so they're doing that. I appreciate them doing that. That's fine. It's no big deal. But again, it's only $50 per point per 100,000. When you look at down in the dollar point, there's other areas that you cut, and people still have to live somewhere. Like, you know what I mean?
Yeah.
You don't have to have that coffee that's $6, but you do have to live somewhere.
Yeah, absolutely.
You know?
Absolutely. Would you encourage people to maybe refinance now or buy now, lock something in to a fixed rate mortgage?
I definitely agree on getting the fixed rate mortgage. I absolutely, if you're sitting on the fence waiting for this market to crash and oh, it's going to have this correction and I'm going to sweep in and buy houses at this ridiculously low price, I don't see that happening. And I do recommend you to go ahead and buy, but not out of fear, but because you need to live somewhere. And why would you want to live anywhere else?
I certainly wouldn't. You've been working in Realty for a while, even including the 08 situation. Are you seeing any similarities between that and now? Because there seems to be a lot of talk about revisiting what happened to the real estate market in 2008, which ultimately crashed basically the entire United States economy for a brief time.
Yes, I was selling real estate. I had absolutely sold a ton of houses during that rise. That was super fun times and really super fun times to keep your real estate license in that crash. But the most amazing part is it is not the same.
Yeah.
So back in those days, people were buying houses. If you had a pulse and a job and a credit rate, you could buy a house with no money down.
Yeah.
It was a total different situation than what we have now. Today, to get a mortgage, you have to qualify. You have to put good money down. You have closing costs. It's expensive. You know, they really have the loans are stricter than they were back then. And we had a lot of people that shouldn't have been able to buy houses that were able to buy houses. Literally, when I tell you they had no money down, they had no money down, $0 to own a home. We do not have that happening in this market. We're not having, it just can't happen. And so even the investors that were coming in and investing, we're not having that as well because they were coming in and investing with these no money down loans. So it's really cut that out. You still have, like in Collier County, 70% are still cash. You know, Lee County still 50-50. So people are still buying even in cash. So if the market, the interest rate's not affected those people.
That's what my parents just did, actually.
Yeah.
They closed this week.
Yes.
Yeah, there you go. For first-time home buyers or for anybody else even who wants to make an investment, put money down on an investment property, do you advise a 20% down or something like that to avoid PMI?
I do.
Because some people are like, oh, you know, PMI might not be a bad thing at the end of the day.
If you have the 20% down, why not put it down and you cut that PMI out? Absolutely. I always recommend it to my clients that are getting a mortgage to go ahead and put the extra money down.
All right. Not a bad idea at all. All right, Aprile, thank you so much for being with us. You always bring such great perspective on the real estate market. Right now it's 9:53. We're going to take a quick break, but we're going to be right back in just a second.